Good day, everyone. I'm Shobana from the IOSCO Asia Pacific Hub. A very warm welcome to all speakers and participants for today's webinar session. We have 204 participants registered for today's webinar session, coming from all regions across the world. Today's webinar session is part of the Hub's ongoing efforts to promote knowledge sharing amongst IOSCO members, as well as the general public in conjunction with the World Investor Week. We hope that today's webinar is useful for you. Together with our esteemed speakers and moderator for the day, we also have with us IOSCO's Chair for Retail Investors, Mr. Pascual Munafo, who will be sharing some brief introductory remarks with us with regards to IOSCO's work on retail investor protection. Without further ado, I'd like to introduce Mr. Pascual for his brief introductory remarks. Over to you, Mr. Pascual.
Hello, everyone. I'm really honored to open this very relevant event. Let me then firstly thank the IOSCO Asia Pacific Hub for hosting this World Investor Week webinar, Shobana Limling of the Hub for the invitation, and the speakers for their availability to share their knowledge and experience on the topic. I'm here in my capacity as chair of the IOSCO Committee A, that, as you may know, is the group in charge of investor education and investor protection policy work at IOSCO level. So we are in the air since 2013, and we published several reports ranging from investment risk, the use of behavioral insights, gaps in financial knowledge, to new topics such as crypto assets and sustainable finance. So as described in the IOSCO report on Retail Distribution and Digitalisation published early this month, namely in the dedicated section to investor education, the 3.6, the C8 has developed some materials to help regulators in their efforts to educate retail investors about the specific risks arising from crypto assets. So the C8 report of December 2020 includes examples on different areas to be covered through the educational materials, such as warnings, educational awareness initiatives, articles, podcasts, and videos. And the C8 is keeping the issues on the list of priorities also through the IOSCO World Investor Week, the 1 week long global campaign designed by the C8 and promoted by IOSCO to raise awareness of the importance of investor education and protection, and to highlight the various initiatives of securities regulators in these two critical areas. So the WIV is grounded on the common efforts of security regulators and their partners, with the support or endorsement of numerous international and regional organizations to shape or simply promote initiatives, ideally taken during the first week of October, but with the flexibility to choose other weeks of October and November to target the retail investors over the importance of taking informed decisions when investing. Every year, we set a list of key messages and topics which aim to delineate the main emerging trends and risks for retail investors. And crypto assets and investing online are mainstreams almost since the very beginning of the week campaign, with the pandemic outbreak, which accelerated the process of digitalization in the last 2.5 years. So in this regard, we specifically developed some key messages on ICOs, crypto assets, and online investing to assist regulators and retail investors in enhancing awareness and supporting retail investor protection. You can find them also at the end of section 3.6 in the IOSCO report on retail distribution and digitalization. So global webinars, which are part of the program of the World Investor Week, as such of today, are relevant opportunities to flag issues and make the public more aware about any emerging trends and risks in the sphere of retail investment opportunities. So C8 is working together with other groups within IOSCO, as for example, the Retail Market Conduct Task Force, as well other policy committees which are touching upon the retail investor dimension to identify these main trends and challenges. So among the other, C8 is conducting a specific project on investor behavior, investor education in times of turmoil to spotlight lessons learned from COVID-19. So the related final report should be released by the end of this year. So no doubt that digitalization offers quite a lot of opportunities to retail investors to approach the multifaceted world of investment. So among the others can positively impact on financial inclusion and reduce some barriers, that might hamper the active participation of individuals and households to the vast range of financial products and services available locally and worldwide. But it is also introducing new challenges and risks, as well as exacerbating some potentially unsafe behaviors. So something that should be promptly and adequately tackled by securities regulators in light of their investor protection remit. So the pace of digitalization within the financial service industry is going very fast, and then the regulators need to quickly react and adapt to this new framework. So the paradox is that, as we already observe in some jurisdictions, instead of being seen as a rowing in the same direction, security regulators might appear as potential obstacles to the trading of new products, for example, crypto assets, and blamed for their activism in the area of investor protection by the so-called self-directed investors. So security regulators at the risk of being identified as enemies instead of as guardians, so especially from the younger generation. So we should keep our calm, though, so we can witness the appearance of new investors, financial products and tools. Technology can surely impact on the overall design of the financial markets. Techniques of financial products marketing and distribution can explore new ways, such as the use of influencers, social media, and so on. But the heart of everything is always the same. You must be informed when considering your investment, aware of the risk you are taking, and willing to do so. Thus, investor education is key, even more important than ever, to be used as a complement of any regulatory and supervisory actions as a booster of investor protection measures. So here a big challenge for regulators in the area of financial education is to move a new and explored area and to speak a language that is understandable by new retail investors, often younger investors. Thus, it's crucial to take advantage of as many communication channels as possible to convey the right messages to the right audiences. So that we've also considering the acceleration brought by the pandemic outbreak has represented a powerful platform where to experiment, evaluate new communication methods, messages, and language. It's a clear opportunity to launch innovation and new developments in the area of investor education and protection. So global engaging, those are two adjectives which fit very well with the intrinsic nature of the campaign. Because retail investors, regardless of their own countries, face the same challenges, and due to the cross-border activities of unlicensed intermediaries, should be protected against the unprecedented possibilities of falling victim of scams and frauds, which are on constant rise and represent an urgent priority for IOSCO and all the securities regulators around the world. So concepts like diversification, risk-reward relationship, inflation, as well as fraudulent techniques like Ponzi schemes, cold calling, wishing, that have been then evolving among the others in phishing and smishing, have been around since, I would say, the dinosaurs, and will survive to digitalization, perhaps under different forms. And then who is in charge of simply involved in educating investors is requested to find the right ways and tools to inculcate the golden basic rules before investing, regardless of the changing environment. And the IOSCO CA is ready, as usual, to give its contribution in this regard. So I stop here. So thanks again for the opportunity to open the webinar. I look forward to the fruitful discussion which is following.
Thank you very much, Pasquale. Now let me also introduce you to our moderator for today's session, Ms. Mhairi Jackson from the UK, and she's also the chair of IOSCO's Committee for the Regulation of Market Intermediaries. Before I hand over to Ms. Mhairi, I would like to make a couple of logistics announcements. Today's webinar will last for about an hour. If you have any questions for the speakers during the session, please type out your questions in the Q&A function and they will respond to it accordingly. Would like to now hand over to Mhairi and the panelists to begin the discussion. Thank you.
Thank you so much for the kind introduction and for the warm welcome as well from Pascal. I'm absolutely delighted to be here today, despite it being on screen and being in London as opposed to Asia, but hopefully next time we should be in person. But thank you so much for the kind invitation. So welcome everyone. Today, this webinar has been organised by IOSCO Asia Pacific Hub on digitalisation of retail financial products. It's a really timely webinar, given that it is the Investor Week, so I really do welcome being here today to talk about this. Consumers have embraced the power of digital financial management and investments in recent years. There's been a boom in digitalization and marketing to retail investors, and trends really have changed in terms of how retail investors access financial services and products. In this increasingly digitalized environment, a big challenge for a regulator becomes how to adapt the regulatory and enforcement approaches to the rapidly changing digitalization trends and online activities. As I sometimes keep saying, it's 1 minute you see it, the next you don't. It's very hard for regulators to keep up with the speed of changes and developments. To this end, 2 weeks ago, IOSCO's Committee 3 on Regulation of Market Intermediaries and Committee 4 on Enforcement and the Exchange of Information published a report on digitalisation and distribution. The report really looks to assist members in adapting their regulatory and enforcement approaches to meet the growing challenges posed by the rapidly changing and evolving digitalisation and online activities that they are faced with. In today's webinar, in conjunction with World Investor Week 2022, we will discuss the evolution of digitalization landscape and offering financial products and services to retail investors. We'll also look at the evolution of regulation in this space, as well as the challenges in regulatory oversight and enforcement activities as well. I'm really pleased and delighted to introduce the esteemed panel that I have with me. So I have introduce Angelina Kwan from Stratford Finance Limited, James Angel from Georgetown University, and Lilli Hattinga Sant from the European Commission. So Angelina is the CEO of Stratford Finance Limited and is a regulatory expert, having worked on the foundation legislation and guidelines that would later become part of the virtual asset service provider framework for Hong Kong. Angelina lectures internationally on that. She was also previously the group COO and CRO at the Hashkey Group and other leading global crypto exchanges. She's held senior positions with the Hong Kong Securities and Futures Commission, as well as Cantor Fitzgerald and other financial services firms. So very warm welcome to Angelina, and thank you very much for joining today. Now let me turn and introduce Professor James Angel. So James is an Associate Professor of Finance at the McDonough School of Business at Georgetown University. His work is at the intersection of financial market structure, technology, and regulation. His interests include fintech, cryptocurrencies, and payments, so very, very relevant to today's markets. He's visited over 70 stock exchanges and commodities exchanges around the world in his quest to learn the details of how markets operate. I'm sure we can all learn a thing or two from James from that. James has also served as a visiting academic fellow in residence at the National Association of Security Dealers. He's a visiting economist at the Shanghai Stock Exchange. He served as chairman of the NASDAQ Economic Advisory Board, and also as an academic director of the FINRA program at Georgetown as well. So a very warm welcome to Professor James Angel, and thank you very much for joining today. Lilli started her career in economic research. She followed this by several years in front office and marketing functions in the asset management sector. She joined the Dutch Authority for the Financial Markets in 2017 as a senior policy officer. She represented the Dutch AFM at ESMA as well as IOSCO, so we've worked quite closely together over the many years. She also led C3's workstream on retail distribution and digitalisation. And in 2022, in September, she joined the Securities Markets Unit of DG FISMA at the European Commission as a seconded national expert. So thank you very much, Lilli. We welcome you to today's webinar, and we really look forward to hearing your insights to the topics that we will cover. So welcome, Angelina, James, and Lilli. Thank you for joining us and agreeing to share your perspective on the topics. I look forward to what is going to be a very insightful discussion. So, why don't we start by looking at how the regulatory or how the landscape has changed within digitalisation over the recent years. The market really has boomed. Retail investors are looking at gamification and different ways and different apps. And the role of influencers as well has really changed the way that retail investors access the markets from financial services products. Angelina, maybe we could start with you, if you could set out from a high level macro perspective how you see the trends have evolved over this time.
Thank you. It's been actually fascinating because as a regulator, when I first came to Hong Kong in 1994, basically the financial markets were very much professional investors, mom and pops that were local Hong Kong Chinese. And in the United States, you'd have the well-off that would trade on their Prudential Beige account and things like that. And they were all high net worth investors. And what you've seen in the last year is a movement of when crypto became popular, with of course Bitcoin being developed, and then at the same time you see an influx of young people going into what was crypto, what is first started with crypto trading, and being empowered. And you're seeing the stock market as well as the crypto markets come together. And you're seeing that more and more in terms of how young people who trade crypto are also getting into buying and selling stocks, which is something that their parents probably did years ago. And maybe they watched their parents doing it. But now with GameStop really unstopped the whole market and just basically opened the whole financial services markets to a much younger group of people. So I was the global COO for a quite well-known digital asset exchange called BitMEX, and we were the largest at the time. And I think one of the things that I found when I was talking to the founders was when they developed the user interface and the UX, it was very much aimed towards young men who were the traders, and they were retail traders, but they wanted to look like as if they worked in a securities firm. They wanted to look like professionals. So what you've seen now is a real change to what was sort of a boring interface for trading in stock. It would be like very non-colorful, to now, if you look at many of the crypto exchanges, as well as the Coinbases and the retail interfaces for trading, it's all very pretty. It's all very colorful. It moves very quickly, and trading is a lot quicker. And when I was at BitMEX, one of the things that we found was the guys were so crazy because they were trading so much that they were proud to actually lose everything, and what we call be wrecked, which is R-E-K-T, wrecked. And they were really proud of it. The faster they were wrecked and lost all of their investment, the more proud they would be, because there was a chat box. And that chat box was where they could crow about their gains and losses. And that also changed the whole way trading actually happened. And what you're seeing now is all the different exchanges, all the different platforms now have chat boxes where traders, retail investors can all trade and talk about things. The last and final change is the ascension of Twitter, Reddit, Discord, and all of these KOL types of platforms that have been very, very influential for both retail investors, young people, as well as crypto traders. And that's been a real function of one of the reasons why the market has grown so much. And probably the main reason why Mr. Musk is buying Twitter right now. So I don't want to keep talking here, but these are just some of the things that you're seeing from, say, 1994, moving now into 2022. You're just seeing such a sea change from what was a very upper middle class industry of trading to now. I mean, kids as young as 15, 16 are already trading, and they're probably really good at it too. I hope that answers the first part, or at least sets the scene.
That's very helpful. Thank you very much. I'm going to share an anecdote. So Andrew Bailey, the governor of the Bank of England, was over in Belfast talking to a group of school children a few weeks ago, and he asked the audience if they had any questions. And one young man put his hand up in the audience. He was about 18. And he asked Andrew if he was trading cryptocurrency, and Andrew said no, absolutely no way was he trading cryptocurrency. But this 18-year-old said that he had his own trading app and was busy trading half an hour each day.
Mm-hmm.
And Andrew came back and told everyone, it just shows you how times have evolved, like you said, from the mom and pops, the high net worth moms and pops, to the school kids, effectively, on their iPhones on the way to school or to university. So now it's very, very interesting. So thank you, Angelina, for sharing that insight. Now, James, maybe we could share your observations with us in terms of how firms have changed their outlook in recent years as they transition to a digital marketing.
Well, I'm always reminded of the old French proverb, plus ça change, plus c'est la même chose. The more things change, the more they stay the same. I mean, the industry has always been at the forefront of using marketing to try to get people to do more trading. And so now they're using the latest marketing techniques that they can find. And this is a global trend that we see rolling out all over the world, but of course, with different speeds in different countries. And a lot of that is based on the changes in their infrastructure and the plumbing of their markets. But one thing to remember is that we are seeing a shift from the old commission-based model to a commercial banking model. Now, in the old days, brokers wanted to churn your account so that they could get more commissions. But think about what a commercial bank does. You deposit your money, they lend it out, they charge you fees for various things, and they try to sell you more products. Well, now what do the brokers do? You deposit your money and your securities, and they lend them out, and they will charge you fees here and try to sell you more products. Now, the commercial bank might give you free bill paying as a perk. Well, the brokers give you free trading as a perk. And what we've seen with technology is the cost of trading has gone down to the point where it really is almost a loss leader for the firms. But again, they are using all of the marketing techniques at their disposal to try to get people to do more, to be more engaged. Now, the problem is that fundamentally a bad thing? No, that every business wants happy customers who come back and do more. So when we talk about the regulatory aspects, I think we need to step back from the moralistic of like, oh my, they're making it fun. Oh, we can't have people have fun. It must be boring. No, we have to step back and think about the fundamental reasons of why we regulate. And I like what Pascal said earlier, but we're basically trying to protect people from frauds, from scams. We want to make sure that we're protecting people from manipulation in prices. We want to make sure we're protecting people from failures of their intermediaries. There are a lot of really good reasons, good objectives for what we do in regulation. And it's always good for us to step back and realize, okay, what are we trying to achieve here? What are we protecting people from? Now, to what extent are we protecting people from themselves? Because it's an open secret in this industry, but we're also in the entertainment business. Is there any other industry that's guaranteed to be on the TV or the radio every day? Maybe sports, which is also in the entertainment business. And so there's nothing really wrong with people scratching their gaming itch as long as they do it responsibly. And so that's really the question. And again, I loved what Pascal said about we want to make sure people are informed, that they understand what they're doing, And we also need to understand that, okay, what do we do when the compulsive gambler gets into the market? That I think is one of the, the big unresolved issues. And how much do we want to protect people from themselves? Again, that's a big philosophical debate.
Thank you, James. Very, very interesting. And I think it'll be interesting to hear how Lilli comes back on some of the areas that you've raised there. So thank you. And let's just, before we move on to Lilli, if you don't mind, James, do you know could you talk through how the recent shocks, this might be better for you, Angelina, apologies, how the recent shocks, such as the recent cryptocurrency collapse and current market volatility, affect firms' strategies and how they respond to retail investor sentiment and behavior for investing? So, Angelina, did you want to take that? Or
Sure, I would.
Thank you.
Yeah, that would be
Thank
great.
you.
I think it's the Great Awakening. And as I said, you've got on one side, you've got the big effect of crypto and people in crypto. And on the other side, you've got the young traders that are trading because of GameStop that got into Coinbase and started opening accounts and trading stock. And then what you saw was, some people use the term irrational exuberance, where basically you had firms that were lending without even checking. They didn't have internal controls in place. And everything that we learn as regulators or ex-regulators of having internal controls, having policies and procedures, those sort of went out the window in the irrational exuberance leading up to this, what is now known as the crypto winter. And you've seen the demise of Three Arrows, where they were very, very cocky young men, and they just lent out or borrowed money irrationally. And you saw that many of the houses just basically opened up in terms of their lending without really taking collateral. The smart ones have survived, but the ones that weren't so smart are now in liquidation. And in fact, tomorrow, Insol will be actually speaking in Hong Kong, and I will be with 3 insolvency lawyers each working on all 3 are crypto firms that have gone insolvent. So to answer your question, I think where you're seeing some changes now is a lot of the houses have moved backwards in terms of lending, leverage, and of course, regulation is kicking in, which is actually one of the best things that could have happened. Many of the jurisdictions in Asia did not have clear rules and regulations. Many of them are now putting them in place. I was in the soft consultation with the SFC this morning, and we're very encouraged that it's going to be much more clear. It is going to be mandatory that houses have to, both securities firms and crypto firms will need to follow, if they're touching in the area of crypto, rules and regulations. So it's going to become more and more clear that the firms will have a responsibility to make sure that their investors know the rules, and their firms that the regulators are regulating have to have policies and procedures in place, and everybody's ratcheting down on risk, monitoring, and making sure liquid capital is in place. We do not want another Lehman Brothers crisis again, and that's, I think, was the really death knell in terms of making sure that firms had proper procedures in place in terms of management of their risk. And I think with this crypto winter now, everybody's taking stock, and all of the bad eggs are now actually being taken out in stretchers through either liquidation or basically being closed down. So it's going to be a sea change. This is not going to be finished. We're only just in the beginning. Our markets in Hong Kong just dropped almost 500 points. Our exchange prices have just gone down to an all-time low. So each ratchet of interest rates is going to affect this, and every regulator has to be vigilant, because their regulatees may have been overextended. And liquid capital, FRR, financial resources rules are going to definitely be very important in this whole process. So I've touched a lot of different things, but hopefully that will be helpful.
Thank you very much, Angelina. Very helpful indeed. Now, Lilli, the growing diversity of financial service providers often requires expanding, redefining the regulatory perimeter. It's always a challenge for the regulators to work out where to set that perimeter. Maybe you could provide us with a brief overview of the regulator sphere and what the major concerns are.
Yes, thank you, Mhairi. So first of all, I need to mention the disclaimer. So any views expressed today are not the official views of the European Commission, but I speak on personal notes. So just to make this very clear, then move over to your question. So what are the regulatory perimeters and what are we looking at? So I think both Angelina and James sketched really well the changes that we see that are taking place at the moment. So on the one hand side, we see the merging between the crypto markets and the regulated markets that happen through the trading apps on the one hand side. And then on the other hand side, we see how also the audience or the customers that are trading are changing. So we went from the 1994 example that Angelina put forward to the typical customers now. So these are a lot younger, and sometimes, as I heard, even underage. I hope not in Europe. In any case, not in regulated markets. That would be illegal. But we can see that there is a different audience. It's not necessarily anymore this well-off segment, but can be younger people. Maybe they have well-off parents. Maybe they don't. But they trade and they're quite active, and they're using all the new marketing techniques that are out there, as Angelina and James really well described. And so a key element that from a bit zoomed out perspective we see as regulators is that the speed has changed, the speed in which retail clients take decisions. So back 40 years ago, 30 years ago, clearly you'd go and have a cup of coffee, cup of tea with your advisor, and you discuss. You get some sort of advice, maybe to the phone, maybe even to the fax machine. And then, you decide what to do. And now these decisions are done in split seconds, and clearly people are triggered by how the screen is set up. So it can be really colorful, or as Angelina said, and thank you for mentioning this because you confirmed a suspicion that I had for quite some time that this is mainly targeted towards young men. So thanks for hearing this from you, actually. It's maybe a bit of an open secret, but always good to actually hear this from the industry. So, you trigger, you target a very particular group, and you have everything in place in terms of testing and interface design to know what they respond to. You have these chat boxes and also, of course, providers know what times of the day people are active, when are they looking at the apps, how to send them push messages, pop up, all this type of stuff to get people engaged. And that is not necessarily a bad thing. And the term of gamification also is not a bad trend because it can be used for many good things. It can be used for financial education. People can learn in a playful way how investing works, but it can also go the wrong way. And this is where the guardians, I believe, kick in that Pasquale mentioned earlier. So as regulators, it is our responsibility to check that these emotional and behavioral triggers that the app poses to the clients, to the users of the app, that they work in a responsible way. And to do that, we have to understand clearly, how do these apps work? What does it do with people? And it's very different from the type of securities markets regulations in the past, where you had the advisor who did a specific amount of record keeping, and we had quite set some procedures. Now everything's a lot quicker. And this requires more responsibility from the firm. And this is why we also brought out this IOSCO report, where we stress that the firms have to have new procedures and rules for their online marketing policies that they put in place. Because it's absolutely fundamental that the firms resume responsibility for the techniques they use. So while we all know from back in the days, the sales staff had a large responsibility to carry with regards to advice that they gave, this is bit by bit transforming over to the marketing staff, because nowadays it's not so much the salesperson anymore who engages, but it's the online marketeer Who knows how the app works? Who knows eventually to which influencer to outsource or to which forum to direct clients? And who I suppose also knows what's going on in the closed up chat rooms that we cannot always access as regulators, or often are not even aware that they exist, or only hear on their existence when it's too late. So this is why it's crucial that the firms and the regulators on this new trend tightly cooperate and really are very mindful, and that we as regulators also dive in deeper into what does the behavioral element do to the retail clients. And I think here we have to lean more and more to what's happening in the tech sector, because clearly with social media, none of this knowledge is new. It's just a bit newer in our sector. But big tech has been investigating this, of course, for quite some time already. So this it's just to state that we need to look closer on what's happening on the tech side to be aware and to tailor our future legislation to that.
That's very helpful. Oh, sorry, on you go.
Back when I was in the enforcement division at the SFC, what we did was we were dealing with the internet already. So we had come out with the internet guidance note. And what we put together was an internet team that did mystery shopping. And we would go on websites, and we had teams of people that would either go in doing mystery shopping with firms. Now, you and I know that firms don't have offices anymore now. Everything's online. So I think for regulators, the best way is for them to do mystery shopping. And I think every regulator should actually have a mystery shopping team that's going out and seeing and at least knowing what's going on in the markets. And I think, Lilli, that's what you said is really, really true. And I mean, this is the best way that people can learn. They should be also looking at some of the things that are on some of the Reddit channels and things like that. If you have kids, I don't think you want to have your kids on them. So, I mean, these are things that I think regulators as well as Interpol should be looking at. And with the metaverse as the next frontier, and as more and more firms, so HSBC has bought Plot, Standard Chartered Bank has bought Plots, Goldman Sachs and all the big investment banks have bought Plots in the metaverse. And unless they are actually patrolled too, there's going to be a lot of issues in terms of things that might come up for investor protection for regulators to think about. So sorry, I just leave that based on what you said.
Yeah, could I come in on this really briefly? Because thank you so much for bringing up the metaverse. Because when we try to build the case internally that this is really a different development, a development that we as regulators with our legislation are maybe not necessarily tailored to yet, then sometimes say, so how are we going to deal with advice in the metaverse? And then sometimes, some of the regulators, not everyone is of course active in the metaverse yet, I would say. As always, the firms are ahead of us, and regulation always is a bit behind the developments, clearly. But then people just think it's a bit of an astonishing thought, but this is really going to happen. So this will be in the metaverse going forward, and then the metaverse is just one example that you could give. But in general, we have to see that going forward with legislations, we have to draft it in a really elastic way. So it's also why I personally always try to think about, let's not only focus on the finfluencers. That's the new thing right now, because there's been a lot of finfluencers, we all know that, and they're very active and so on. But we also have to consider what else could come. So what's the finfluencers now will be, I don't know what, in 5 years. When we started to work on this report, a colleague from South America mentioned TikTok. It was in 2019, and we were saying, TikTok? Should we survey on TikTok? Who's on TikTok? It's a dancing app for girls. And he said, no, you should look at TikTok. It's going to be the next thing. And then, just a few months later, we're all in lockdown. TikTok really took off. And we were sitting there and we were thinking, wow, we did our firm survey just before the pandemic. And even at the time, 70% of all firms said that they are planning to increase their online presence massively in the various channels. So, I mean, after the pandemic, clearly this would be well above 95, let me put it like that, I suppose. But at the same time, we asked the regulators who's planning to increase their supervision in this particular area pre-COVID. And this amount was significantly lower. So I think now all regulators know this is the area we have to go into, but at the same time, the regulators have to start building up knowledge in this area, and they have to see how, for example, micro-targeting works and how the behavioral triggers work and so on. So my former employer, the Dutch AFM, they've been quite active in this. They have a specific team on conduct and culture that investigates these behavioral biases. They try to, build certain applications to see what's going on for supervision on online channels. But these are all things that also for regulators are relatively new territory to go into, and where we as regulators need the cooperations of the tech firms, and that can be quite difficult to get there, to cooperate, to ensure that the investor protection is still granted for the retail clients.
That's very, very insightful. So I think you've given us lots to think about, both in terms of how we write the legislation and regulations, but also how we supervise and think about enforcement. So you've spoken about not ruining people's fun. James, you mentioned earlier, it should be fun. It's entertainment as well. And then Angelina, you've mentioned the need to do mystery shopping and to look at web chats and to look at what is being said on the intranet, such as Reddit and things. James, Angelina, have you got any other advice that you would give to regulators at the moment in terms of how they can up their knowledge as to what's happening within the markets and what they should be considering for their supervisory and enforcement approaches?
Well, I'd like to emphasize the role of mystery shoppers, in that one problem we have in the US is that our government regulators are effectively prohibited from doing any real trading and really getting into the environment. So the more we can do to actually get them to understand and participate, I think the better it will go. There are two other points. I'd like to point out that a lot of people really misunderstand, quote, crypto or so-called digital assets, and they view it as a new asset class. Well, we've been tokenizing things in our industry, for 400 years. A paper stock certificate is nothing more than a token of ownership. What's different about crypto is it's really a new settlement rail that takes place using distributed ledger technology. So it's basically a new way of transferring value. Now, but the real question is, what do those tokens represent? And so understanding the role of tokenization, I think, will give people a lot of clarity into how to deal with this space. So if you think about all the regulations we have about our settlement rails, about rules for the intermediaries, capital requirements, and all that, obviously we have the same regulatory objectives. We want to make sure that people's funds aren't being stolen. We want to make sure that the system doesn't collapse. Okay, we have the same objectives, but since the details of the technology are so very different, that's where we need to rethink regulation there. One of the problems that we run into is, especially here in the US, we have this regulatory mindset. Oh, we have these rules, and oh, what bucket do you fall into? Are you a commodity, security, bright, shiny object? Then we have to apply these 1933 rules to you. But do those 1933 rules apply with this new technology? If you think about taxi regulation in New York City, they have to have a bulletproof shield to protect the driver from being robbed at gunpoint. But with ride-sharing services that don't carry cash, you don't need a bulletproof shield. So when we have this sort of new technology, we do need to rethink the regulation, but the most important thing is to focus upon what we're trying to protect people from, why we're regulating, rather than how do we apply some 1933 rule. So I'd say focus on the regulatory objectives, focus on understanding what's going on, and I think that will enlighten the regulatory burden, or rather the regulatory tasks.
I think James has hit the nail on the proverbial head. And I think if all regulators actually keep that in mind in terms of looking at what it is, they won't get so bogged down in everything else. Because yes, everything is moving very quickly, but ultimately, who are you trying to protect? How are you trying to protect them? What are you trying to protect them from? Will be very, very important. But the other thing that I think that regulators need to get is resources. The laws are not moving fast enough. Even for us in Hong Kong, we are introducing the virtual asset legislation under a new set of rules because our Securities and Futures Ordinance is too hard to change to deal with virtual assets. So we're using AMLO, or Anti-Money Laundering Ordinance, Reporting Ordinance, to actually put our virtual assets. So I think having the freedom of a more, shall we say, an open legislative process will help regulators. The other thing that I don't think people have thought about, which is something that I'm bringing up the alarm bells now with the government and regulators in Hong Kong, is guess what? There's something called Web3 that's coming up. And this is going to vastly change how people do business and the entire way that Google, Meta, and all of these giant firms are going to work, because you're moving into a completely decentralized system of which ecosystems are built. So I think regulators also need to be able to have the fluidity of exactly what James said and what Lilli has said in terms of having legislation that's fluid, that can handle Web3. And Web3 is here now. So metaverse is a part of it, trading is a part of it, and the future is moving forward. So don't want to scare you all, but it's real.
Thank you, Angelina. I think we've got our work cut out as regulators. It's a constantly evolving landscape and lots of different priorities to try and juggle. So I would absolutely agree, resources is key. Lilli, before we kind of started the webinar, you mentioned earlier today that actually Europe's learnt quite a lot from Asia and from some of the emerging markets in terms of the regulatory developments and the landscapes that are occurring over there. So maybe you could talk about some of the lessons learnt and what you've seen globally.
Yes, indeed. So in Europe, clearly in our MiFID II environment, we have quite a maybe globally seen, or so to speak, a more restricted regulatory universe that we're operating in. So when we were working on this report, it was also the question, what's happening in other parts of the world? And for me, it was clear quite quickly that we have to look towards Asia, because generally just to smartphones, it's Asia, the market that you have to look to. In Europe, we were still discussing what's happening on desktop, while everything in Asia is already tailored to your smartphone screen. And then you all know everybody has a smartphone. The screen is a lot smaller. You see different stuff. It works differently. You can do it from anywhere, anytime. It's just a different tool. And the providers also use this different tool in different means. So for us, it was really fantastic to be in this IOSCO environment where we could profit from the knowledge that the colleagues in Asia had on how they have designed the legislation there and what they see with regards to, for example, the role of the online marketeers, what they have to do, and how firms have to deal with the role of online marketeers. Because as I said earlier, I think they're going to, so to say, take over the traditional position of the sales channel in the organization, and it will all turn into one online marketing / sales role, while and online marketeers are going to get, so to say, going to move up in the hierarchy likely over the future. So that was really good to learn, to see how the Asian colleagues have looked at the various mobile app trends before we had, and had also looked on what's happening in app stores, how apps are being put out, who is on the apps, but also looking on how, for example, which type of clients are starting to trade and at what times of the day, and these type of things. So for me as a regulator, it's crucial to say here this. It's important for all of us in the regulatory environment to exchange more with one another, because we can really learn in this development. And we come from a world where everybody refers to their national legislation. I think James made the point with the 1933 rules in the US, and everybody has these type of rules, right? It's not only the US. This is worldwide. In Europe, we have the European legislations. But what we need in this trend, in this purely decentral or globalized trend, is that we have to see that we try to move our rules all in the same direction. So the cooperation here is absolutely essential. And I personally believe we shouldn't look with the more old view from developed versus emerging markets on this, but this is really more on digitized versus less digitized markets. And it should be, we should all leverage off the experience the digitized markets have, because they are ahead of us and we should learn from them.
Agree. Very much so.
Thank you very much, Lilli. Before I open the floor to questions, Angelina, James, Lilli, did you have any remarks that you wanted to make?
I think IOSCO could help its regulators more in terms of its members more. We're seeing really interesting advances through some of the newcomers into the market. So Dubai VARA has been quoted many times and I've been asked, well, do you think Hong Kong's going to do a VARA? So everybody's saying, do a VARA, which means set up a new virtual assets regulator that will be standalone. So I think this is something that maybe IOSCO could look at, or IOSCO members can share working with VARA and just share amongst each other. And I think this whole training course that Shobana first discussed is very helpful. When I was a regulator, we didn't have Zoom like this. We actually had physical meetings. But now with Zoom, I think regulators sharing their experiences like this will be very, very helpful for each other to learn from each other. Because only by working together can we solve problems together. So I think this is going to be something that's very important. So that's one thing out of this whole, just this session alone, just learning from Lilli and James and yourself, I can see that there are many things that the members can do.
Yep. No, thank you, Angelina. I think it's a privilege. I always think IOSCO is such a privileged opportunity to meet with regulators across the globe, and I always welcome the opportunity to exchange views and to learn from each other. I'm just waiting. Please do, if anybody does have any questions in the audience, please do use the Q&A function to raise some questions. Lilli, was that a hand up from you to make some further remarks?
Yes. Yes, just really briefly, I would just like to tell to the audience, the ones who are not from the regulatory side, that clearly often the regulators are seen as the people that stop the fun or try to be difficult with all sorts of red tape, etc. But I would just like to stress, as Pasquale said in the beginning, our role is to be a guardian. And I think now with the crypto winter, I'm just taking over this term that you guys brought in, it's more clearer why we need this guardian, but ultimately not only in crypto, because I'm not from the crypto, but from the securities markets, but especially in the securities markets, our role is also to ensure that the investor protection is there to ensure that the clients, and that also being the retail clients, maintain trust in the financial markets, because once that trust is lost, then we really have a problem. So this is just to say why regulation is necessary, and we're trying to adapt. As regulators, we are always a bit behind the curve, but for us it's absolutely crucial to cooperate with the firms and to learn from them and also from each other to make sure we can maintain the trust in the financial system as a whole.
Thank you, Lilli. I think that's something that absolutely resonates with the UK FCA. So we're looking to change the way that we actually reach out to investors and the way that we kind of market what we're actually doing. So we've come up with our own gamification ads, and we're using TikTok and Twitter and YouTube and things that we never ever would have done years ago. So times are definitely evolving on both sides. James, have you got any further remarks that you would like to make?
Well, I would just like to point out that I have a knee-jerk reaction to setting up yet another regulatory agency. In my country, we have hundreds of financial regulatory agencies, and the coordination is immense. And so, again, we have the same objectives. We want to protect investors. And if you view crypto, again, as a settlement rail, then we need to think about, all of the reasons we protect people in the settlement space from failures of intermediaries, making sure the system works. But also we need to make sure that the tokens that are traded are not fraudulent as well. And we're seeing a merger of the TradFi, the traditional finance space, with the crypto or so-called digital asset space. And so as more and more TradFi firms get into crypto, we'll just having an additional regulator just adds another level of complexity and another level of jurisdictional disputes between regulators. But we really haven't talked much about the so-called DeFi or decentralized finance space. And again, I too believe the metaverse is real, and we're going to see a lot of interesting things happening there. But also, when you think about decentralized trading, and where you have a protocol instead of an exchange, and where you have things like Uniswap instead of market makers, this brings up a whole nother level of complexity as to how do we monitor and surveil trading to clamp down on manipulation and insider trading. And that's a whole nother level of issues. But fortunately, when you look at these allegedly decentralized protocols, the more you look, there's usually some degree of centralization. Somebody has administrative keys, you have a group of core developers, the people who set it up have these governance tokens, whatever they are. So there are definitely degrees of centralization that the regulators can approach. And I think that's an important thing to remember. But as always, we need to step back and ask ourselves, okay, what is our regulatory objective? Again, we're trying to protect people from fraud. We're trying to protect people from failures of the intermediaries. And to a lesser extent, we want to make sure that we protect them from themselves, but we also can't bubble wrap investors and not keep them from making any losses, because our economic growth depends upon having people willing to take risk on ventures that may or may not succeed. And so what I see, most of these tokens are really technology plays on new and unproven technologies. And that's where our economic growth is going to come from. It's going to come from new technological development. So we want capital markets that will provide, the investment in these risky areas, because we know some of them are going to pay off. We just don't know which ones. So even though most of those speculative investments may fail, there's nothing necessarily wrong with that. You can look in our TradFi market. We have hundreds of biotechs that trade in the US markets. And probably most of them are not going to come up with a cure for some awful disease. They'll fall by the wayside. But the ones that do may be bringing us the vaccine for the next pandemic. So, in our zeal to protect investors, we must also, protect the future by providing an environment where we can harness our capital markets to move the economy forward.
I think that's a difficult balance to take, because indeed we have to make sure we have liquid markets and that firms can develop. But at the same time, when it comes to retail clients, they also have often more long-term financial plans and ideas. So you could either have people trying to save for their retirement. Now they're likely maybe not the most active traders in apps at the moment, but potentially will be in the future, so to say. And at the same time, you can have quite young groups of people that just don't have that much to lose. So we also, for them, have to strike the right balance so that we can ensure that the firms also protect the actual goals of the clients and act in the interest of the clients. So that is also crucial, because for venture capital to go out and finance all sorts of firms that may or may not come up, that's one thing. But I think it's a bit different when it comes to a retail group of clients that you cannot bubble wrap people, but at the same time, they have sometimes what they invest in has to be aligned with their high over objectives. So that's important that's taken care of too, I believe.
And I think education is probably the key to all of this, in terms of if you've got education out there, and now with the tools that we have, either through IOSCO, through podcasts, through TikTok, we can get the word out to investors. We can teach them about DeFi. We can teach our own regulators about all of these things. And I can tell you the regulators can't even keep up with all the changes that are happening right now. And as I said, Web3 to me is probably one of the most daunting things that's actually going to be happening in the next year to 2 years, because it's already happening. And we can't even keep up with those changes, much less the legislative changes. So I think I agree with everything that both James and Lilli have been saying. It's thinking smart and planning smart and being educated and having resources. I think that's where regulators need to think smart about how to protect their regulatees as well as the investing public in their particular country.
And I just want to agree with everything that's just been said. As an educator, obviously, I believe in education. But the real question is who can do it? Because we all know that regulators all over the world are under-resourced. Nobody is banging on their legislator saying, spend more on regulation. So every regulatory agency around the world does not have enough resources to really, do everything that it could and should be doing. But the firms that are actually benefiting from this activity also have an incentive to educate. And one of the things we've been thinking about in the US is other countries as well, complex products. Who should be allowed to trade what? And I think one thing that we can do is say, all right, let's have levels of expertise that when you demonstrate that you have mastered a certain body of knowledge, you can move on to the next level. So you can become a level 1 trader, a level 2 trader, a level 3. And, basically, let them take little tests to demonstrate that they really understand what they're getting into. And by having those permissions, the industry will have an incentive to educate people to get them from one level to the next. So when we look at how we regulate complex products, if we throw out the asset-based caste system that we have in the US, if you have $1 million, you're accredited, and instead go with a sophistication-based level of if you pass this test, you can buy these products. If you pass this test, you can do this. That way, we give the industry an incentive to educate people. So definitely we should think about that, because obviously each regulatory agency just doesn't have the ad budget, doesn't have the budget, period, to really do education, because education really is a labor and capital intensive area.
I think those levels of supervision, it worked in Singapore in terms of before investors could trade in futures, they had to pass a test. So putting those guardrails in place would be much better than just outright banning all trading in retail. And I think if we have the right guardrails in place, we test it, make sure it works, then that's much better than just squelching an entire asset class from investors, when in fact you can just go down the street and go buy Bitcoin. I hate to tell you this. Anybody can just do it if they really want to do it. So why don't we just put some controls in place, working with the market and working with firms to come up with something that will protect investors and to make sure they know about whatever the product is, be it stock, be it GameStop, be it virtual assets or futures and options for that matter. So.
No, thank you. I think we're all probably in violent agreement there that the markets need to change, regulation needs to evolve, and that we can't squash and shouldn't squash people's fun. Investors should have the choice. This is my key takeaway. My key takeaway is we're killing people's fun, but quite seriously, we need to work with the market and evolve with the trends within the market. Otherwise, the regulation is literally going to be left behind, and that's going to create more consumer harm than good. So thank you very much to Lilli, James, and Angelina for their insights and their thoughts today. Really very much appreciate it. I found that topic and that discussion very, very fruitful. You've certainly given me a lot to think about as chair of Committee 3, and things for me to take away and to think about actually what are the work IOSCO could and should be doing in this space, and how we could be improving and enhancing the global cooperation as well, to make sure that we all learn from each other. So thank you very much. I would just like to pass back to Sharina, my IOSCO colleague. Thank you.
Thank you very much, Mhairi, and to all speakers today for sharing your valuable insight. Thank you also to all the audience for your participation today, and we look forward to seeing you in our next program.
And Ms. Jackson, great job as our moderator. Thank you.
Thank you.
Yeah.
Thank you very much. Thanks.